And joining me on the podcast right now, and of course, you can see Paul with his brand new haircut live on video. Paul Hill, of course, full-time investor, equity analyst. And I gotta say, he's looking sharp. If you're listening to this on podcast, it's worth switching over to the video. It's DIY. But Paul, you said to me you've been doing this since lockdown. You're getting the hang of it. I think that's quite a sharp look you got there.
Well, it's a bit like my portfolio, Stevie. So my portfolio's definitely lost a lot of weight, should we say, over the last. And I thought it was just my head might need a bit of help as well to lighten the load a bit. But yeah, I mean, we've had a really sort of rocky last couple of weeks on the market since we last spoke, and then culminated with just a total whipsaw yesterday out in the S&P. With the US CPI, which came in hotter than expected. Core came in at 6.6% versus expectations of 6.5%. And then we had the market selling off, which is what I expected, because pre that in the futures, it was up 1% and then went down about 2% about as soon as the bell opened on Wall Street. And then at 11 o'clock in the morning, having opened at 9:30, it just sort of totally turned around and it closed the day up on a reverse of about 1,500 points on the Dow. So it ended up over 2% up. And I guess that comes down to two things. One, because it was hotter than expected. The initial reaction was bad and bonds or treasurers went up, and they're now baking in another 1.5% increases on the federal funds rate from 3.25% to about 4.7% by sort of April next year. So the bond market reacted as you would expect. The equity market going down reacted as one would have forecast, i.e. negatively. But then really what was quite interesting, and this goes down to trading or investing, because there were so many people short of the market going into it, they all decided then to take profits at the same time, which ended up to be a short squeeze. So the irony of the story is they were dead right on the economics and on their logic, but they were dead wrong on their trade because they ended up taking a bath. But I mean, that just shows you in terms of broad picture, a number of different things. One, the algos and the computer boys are driving the short-term nature of the market. So don't get spooked by large swings, even in the major indices. And the other big thing is that I know lots of people are saying, oh, they're really smart and they're out the market holding cash. Well, it just goes to show how difficult it is to predict when there's going to be a big rally on the stock market. And if you miss some of these major moves on a daily basis, and because you're not in, then frankly, you're going to take out a lot part of your long-term returns. And I would just point investors to take a holistic view as you and I do and say, yes, our portfolios are doing badly at the moment, like everyone's else are. We all don't like it. But in 5 years' time, they're likely to be a lot higher than where they are currently. And that's what we're doing. We're looking at long-term investing. So don't get totally spooked by what we see. Well, my haircut anyway, put it that way.
Yeah, well, do you know what? It's just funny that there was a support level. The June low of the S&P 500. Okay, was on the 17th of June. It hit 3666. That's the number it hit.
Oh, see, okay. The number of the beast, isn't it?
Yeah, and then we rallied, of course, in July and August to what it was, a 20% rally of 4,300. And then we were on the edge that we come back down to that level, 366 yesterday, went below that, but it spiked all the way back up. So it went way below 3,400, but it's come back up now to that level. And now that's resistance, but the futures are showing up today. So if it gets above that, which was the previous low, that's quite good. And I think, how much of the bad news is being priced in here? Because we're all aware of the bad news. We're all aware. And we've said before, there's no good news being priced in. But if you look at the rate hikes and where they will go, next three, maybe they'll be done, the Fed, or close to being done, so you can see the end. There's light at the end of the tunnel here. And I say markets hate the uncertainty of how high Fed's going. But I think, how high can they go? And of course, inflation takes a while to tick down. It will. I think the longer it stays up there, you may have a big tick down in one of these months, and then all of a sudden the markets will rally. But yeah, I think we're not far off,
Yeah, I mean, last time we spoke, I mentioned the rubber hits the road in October when it comes to the CPI, because you get some of the year-on-year base effects falling out. And when I spoke to Jamie Constable of Singers yesterday, and he said exactly the same. He reckoned there's going to be about 1% or 0.9% should come out on a month-by-month basis out of the October CPI. So he's seeing the same, and that could really be a major catalyst, particularly if you back it up with the November CPI, which does something similar, and that comes out in December. And that should take some of the heat out of all the interest rate. Yeah, and the other thing, when I mentioned, spoke to Jamie, I asked him what his price target was for the S&P 500 for the next 12 months. And he came up with he thought it was going to be positive, so around about 4,000. And that actually chimes with what I reckon, because if you look at the S&P 500, it's currently roughly round about predicting on an EPS level of round about, I think it's about $218 per share for this year. So if we're flat for next year, and we assume then a sort of 15% increase in EPS for 2024, i.e. look next 12 months ahead, then you get to around about 250. Just doing the maths, 4,000 divided by 250 per share gives you about 16 multiple, which is around about the 10-year average for the S&P 500. So yes, I think you've got to look through the short-term volatility and the pain, and sort of say, yes, there's not only the charts support that you talked about bouncing off the lows, but also fundamentally in terms of the earnings power of the S&P 500. If you say, okay, right, the back end of this year and early of next year is going to be a bit of a write-off, a bit of a sort of trudging through mud, etc. But when you look through that, and the inflation saga has ended, and hopefully the Ukraine-Russia, that's had a ceasefire over the next 12 months, then 2024, if China particularly then also has come back, then should be a lot better. But it's one of those things. It's all that short-term trading, chartist versus long-term investing, and me and you in for the long-term investing. And if people adopt that approach, then they'll get through this short-term pain.
Yeah, and also you get people's sentiment. Even when I've had a couple of nice bounces in some stocks recently of mine, and they seem to hit their lows. Touch wood, but it's amazing how sentiment can flip from how far can this go down to wow, this is cheap. This could go up a long way. That kind of the fear and greed aspect of it. It flips very quickly, and people don't understand that. Because we've had doom for months and months and months now, but that can flip from risk to reward very quickly, and the markets just pile in. So and like I say, those bounces from the bottom. I think there was a stat, wasn't there? If you missed some of 10 of the best days in 5 years, it's like a huge percentage drop in your portfolio gain. So go. Any company news up there? Yeah,
well, I mean, basically, just coming on exactly onto that, you've had one stock which has been absolutely annihilated, and along with the whole sector, which is sort of online retailing. But Marks Electrical is just bucking the trend. I mean, when you compare it against its major peers, AO World, John Lewis and Currys, etc., it's winning market share hand over fist. And it came out with a sort of like a half-year trading update. And it's actually said its like-for-like growth increased over the last 2 months from sort of an average of just under 14% in the first 4 to over 16% in the next 2 months in August and September, to give you a sort of combined 15% like-for-like growth. And a market that's actually down. And that just shows you that model they have adopted, which is, digitally native and, excellent customer service, high trust pilot score of 4.8 is really chiming with consumers. And I've mentioned to you before, I bought my sort of Bosch dishwasher from them, and I couldn't sort of praise them more highly. They came earlier than I expected in terms of they arrived 2 days earlier, and they said they were going to, they told me when it was happening. They arrived at sort of 7:45 on a Saturday morning, installed it and delivered it for, basically for free. And, it was all done brilliantly by Lee and Alan at the time. So I'm one of the customers who was absolutely delighted, and genuinely, I would recommend for customers to use Marks Electrical any time of the day, because I got a really good price, a great product that I've not had any problems with. And it was all done very easy. They took away the old broken machine, recycled it, and I mean, my wife's absolutely chuffed to bits, and she wasn't even there in the morning. I mean, for me to do something like that and I didn't have to do anything was great. So anyway, they're knocking the ball out the park in terms of theirs. It's been slightly tougher on the marketing side, the competitive landscape. More people have been promoting, so the cost of advertising online has actually gone up. But also with this sort of price discounting has been a bit more intense in the first half. So that's hit margins. But they're seeing that easing going into Christmas, which is really interesting because it means that, essentially, people's budgets have been sort of spent up to that, not consumers, but their competitors. So that should help margins going into the second half. And even so, they're still bang on track to meet their full year expectations. So that's another one in terms of go best in class. Even though the whole sector is hated, then, stick with the winners. They've got plenty of cash. They're generating, they've got over 7p per share of cash. So, and I think they trade on around about sort of 12 times PE, sort of 9 times EBITDA. So, I mean, when you look at that perspective, they're a value play who's growing top line at 15% per annum.
Yeah, but you know, I was talking to John Human yesterday on Fox Screen Stocks, and I was saying there's a place in your portfolio right now. I mean, you should have a couple of stocks in there, depending on how many you hold. There's inflation won't affect them too much, and maybe some even benefit from inflation. But if you look at, like I said, best in class discretionary spend, cyclical stocks, there's a room in your portfolio because they will recover very quickly if they're doing well, and yet they're just being taken down by general sentiment. You've got to be a bit discerning. You can't just jump into. I mean, the whole sector will rally, but the really good businesses that are still doing well in this environment will bounce back very strongly. Because like I said, Marks hadn't been hit by it really. It's been dragged down by consumer sentiment. It's been non-stop. People. In fact, I covered Hollywood Bowl. Their results were very good, recently, and yet they've been knocked a little bit. And they said we've seen no effect from it. And I as you know, I owned XP Factory, and they've seen Richard come on the podcast this week, and he said we've seen no effect from the consumer spend. We're still doing very well, and growth is up there. The growth is phenomenal. Going back, I was chatting to him this time last year, they had 8 escape hunt sites. That's all they had. End of this year, they'll have 23 of those, 25 franchises around the world, and 27 boom battle bars. And so the growth is amazing. And so we just roll these out. If they're not working, we don't roll them out. We said we are hitting mature margins straight away. He said escape hunt, for example, EBITDA margins were boxed economics of 30%. They're doing 39% on that. Boom battle bars doing over 20%, 22, 23%, and some of them are huge. Like they're going to open Oxford Street. And it's 15,000 square feet. It's massive. Now, just as a judge like for like, Cardiff is a very good boom battle bar, but it's about 6,000 square feet. It did 4 million of revenue last year in a lockdown year, pretty much. Now, the one in Oxford Street is almost 3 times as big. So those two together will do almost 10 million in a good year. But their margins are very good. They're growing very quickly. But I said that Marks Electrical, Hollywood Bowl, stuff like that are doing very well, but being dragged down by the general sentiment will rally strongly, I think. As soon as these worries fade, and it's been going on for so long about people staying indoors under heated blankets, but people going out, for events and stuff like that, or good products, they'll still spend. I'm
with you. I think if you have in your portfolio, if it's fairly diversified, a part of sort of like cyclical recovery stocks that have been battered at best in class, I don't think you're going to go wrong because these things are not going away. They're certainly not going bust, and if anything, they're increasing their competitive position because they're winning market share. So when the market does return, they're in a better place, and the shares will absolutely go through the roof because they'll as consumers come back into the market. Yeah, so I'm with you. I mean, do you know
what? I think I've been looking. I'm obsessed with the chart of Boohoo. Right, I'm obsessed with it. I'm looking at it all the time, and I'm thinking that they could. I mean, I know they're going through a sort of transformation as far as automation and like warehousing and all that. I think if they could do that, it helps the margins, and of course, costs come down. Shipping costs are coming down anyway. That they'd be so hammered, unbelievably hammered. And I'm thinking that they can recover very quickly if you start.
Oh yeah, no, they can. I mean, and I would say, I wouldn't be surprised if somebody knocks on their door and puts them an offer as well. So at these levels, just where the brand is. I mean, what was also quite interesting 2 weeks ago when we chatted, I highlighted that I just bought Argentex, which is a foreign exchange sort of dealer trader platform, and does sort of like forwards and futures for corporates, large corporates, and for the financial community, sort of hedge funds and fund managers and high net worth individuals, etc. And I said that I'd like to. Anyway, it came out with the trading update on the Monday after.
Knocked out of the park there, didn't it?
It was just the cover came straight off the ball on that one. I mean, the revenues are up 75%. So I mean, they're absolutely doing brilliantly, totally flying. Their broker, given that they've got the interims out on the 8th of November, decided not to amend their numbers, even though it's almost dead cert they're going to increase. But I've done that on mine, and I just put a modest number in for Q4 revenues of 10 million. Their current, on the last 6 months, their quarterly revenue average has been over 13. So even putting 10 in, and you bump up the EBITDA by about 2 mil. And even at sort of like £1.05, they would still be trading at less than half the market in terms of EBITDA multiples. So they're still very, very cheap. And I think they're going to go up, they'll do very well indeed. I mean, what the real sort of growth engines are, they're winning market share from the main sort of competition, which is the traditional banks who have about 85% of it. They've got sort of like, a very bespoke, they've got a bespoke customized service. They're moving overseas in terms of regulated markets like in Holland and Europe and Australia. They're also investing heavily into their tech platform to be able to do straight through processing and mass payments. They can do it, but it's sort of like they're making it much easier, more towards sort of the equals model on that one, but not forgetting obviously their bread and butter, which is obviously doing all the advisory on the forex, etc., for larger transactions, and that's about 50% of their business. So yeah, I mean, they're doing really well, and even though the shares ticked up, when you bake in the increase in the expectations, certainly on my expectations, then actually they're cheaper now, having the share price gone up in valuation terms than they were before they came out with their trading update, even though the shares have gone up by sort of 15%. So yeah, I mean, they're doing absolutely brilliantly, and the CEO, I'm sure.
Yeah, Jenny, I like to, as I said, we talked about them twice with me and John Newman.
Oh, did you? Okay.
Looking into them, and then you mentioned them on our last episode.
The other stock which is really interesting in that whole sector of sort of like international payments and e-payments is EQLS, and that it came out and almost it was on the same day. They've done a sort of little bolt-on acquisition of this 48% it didn't own of EQLS Connected, bought from its previous owners, which had been working anyway. So it's a very low risk acquisition that's already been integrated within the business as a subsidiary of 52 subsidiaries. So it's really a sort of like a tidying up that whole portfolio. But again, the business is absolutely flying, and that was a really good earnings accretive acquisition, low risk, no integration costs, and pays for itself, very, very quickly, and from the increasing cash pile that it has. But just as interestingly, at the end comment by Ian Strafford Taylor, it was lovely. He basically said he'd seen the strong performance in the previous first half and year to date, up when they announced their interims at the start of September, had continued throughout September, which says to me the business is flying still. So yeah, I mean, I think they're really strong. And we talked about Argentex, going to be upgrading, certainly formally, with Singers in November when they put their first half. I'd be surprised if EQLS don't do the same, because they've got the expectations out there are still quite modest, and it will certainly be upgrading, or almost certainly, and nobody knows, but certainly, in my view, upgrading for 2023's estimates, because the momentum behind this business, and you'll really start then seeing the drop through rate. So two fabulous and sort of like relatively cheap stocks that are doing really well and bucking the trend, and have got inflation hedges, because they're effectively taking a percentage out of the total monetary amount forex. Argentex and EQLS, and they're still cheap. And so, both of them are, I think you can pick and choose which one you want. EQLS is more of a platform play, straight through processing. It serves more small, medium-sized enterprises. It's gone upstream into sort of large corporates as well. But it has less exposure into traditional sort of Forex advisory. So it only does about 10% of its revenue, which is forwards and futures, whereas Argentex is more along the lines of the classic sort of like, Forex dealer broker type of stuff, and that's about 50%, but is going more into the platform, the technology, and the straight through processing. And they're both competing against the mainstream banks and winning, market share hand over fist. And the management teams are both doing great. So I'm delighted I own both of them. Obviously, I've been in EQLS for a long time, and I'm going to stick with it. And I said to you before, if there's any sort of, if I get some more cash and there's a pullback in Argentex, I'm going to be buying more in that one. I don't need to buy any more in EQLS. My position is pretty full.
Yeah. No, like I said, John and I were looking at that twice, and the fundamentals stacked up. And then second time you mentioned them, just before we on the day after you chatted about them, I looked at the chart as well, that they are starting an uptrend, which in this market, I mean, like I said, 86% of AIM stocks are below the 200-day moving average. That's, they're in downtrends. And I thought, that's odd. And then they came out with that trading update and then whoosh, straight up in the air. Next day, so, okay, that's good. And of course, listen, then we know central banks, they're up in their policies, their interest rates, and so there's going to be a lot of volatility, isn't there, on currencies? So that's good for them as well. So and it's a good fundamentals are stacking up, the backdrop is stacking up for them, and even if you on the last issue look at the chart, it's all stacking up for them as well. So it looks good. I tell you what, outlooks. Just mentioning. I've been waiting for a while now, hoping this one I was going to talk about eEnergy's results and the trading update. And I was looking through their figures of what they've announced already. And I'm pretty sure there's going to be an upgrade here, okay? Because just looking at what they've announced already, now they've got a lot of forward contracts already contracted. And they had 88% of Q1 revenue before the quarter started, 40% of the entire year's revenue before it started. And I was looking at that, and they're forecasting about 30.5 million this year in revenue. And I thought, okay, I'm working on that in maths pretty much. You can see they only need to achieve less than 5 million per quarter in revenue to beat estimates. Now, last quarter they did 8.3, quarter before they did 8.4. So then there's quite a good chance here they could exceed 30 million this year. And of course, it's not getting less busy, the energy market, even with the government cap I was looking at. At the start of 2021, businesses are being charged about £50 per megawatt. Even with the cap, £211, so 5 times as expensive right now, even with that government energy cap. So it's a major concern for businesses. And I think there's an ONS report out this week saying that 22% of businesses, their main concern is energy. It's not whether they're doing business or whether they're selling product or services or labor costs. It's energy, and that's gone up from 15% a few months before. So it's a major problem for businesses, and it's going to drag on, energy intensive business a lot. So it's a headache that's not going away for a while. And we can see from inflation, it doesn't tick down very quickly. It hangs around for a while. So it's a very hot area, and companies are looking to reduce their waste and energy bills. So yeah, I think it's a good chance. I'm just looking forward. I mean, I expect the news to be out by now, but maybe next week. But I'm thinking this year they're going to do very well, above those expectations, because it's quite a low bar they need to achieve to get above those estimates.
How much what's your exposure to eEnergy in your portfolio? What percentage is it?
I never try and go above 20% in any company. They're between, I think, 10 and 20. They're not above 20, but about 15ish, depending where it's
right. Okay, so it's a big slug, isn't it?
Yeah. I mean, my top three are now pretty. XP factory gladly rallied a little bit now. It's up about 60% from its low, which is nice. And Trufin as well is a bigger holder. So those three, Trufin, XP, and eEnergy, are my biggest holders. In fact, Capital Markets Day yesterday with Trufin, I was really impressed with it. All parts of the businesses I'm impressed with, but the one that's the monster is Satago. It's, I mean, by far standout. And they're saying there's nothing else like this in the market. Essentially, for a tier one bank to do what they've done with Satago, they need to implement deals with like 16 third parties. Satago can cover all that in one go. And they're saying pretty much by 2030, the brokers are saying this is pretty much 80 to 100 million revenue business per year with EBITDA margins above 30%, 30 to 60% across the group. But I mean, it's one of those things you look at and thought, I like PlayStack, Oxygen, forward guidance and revenues are contracted for years in advance. But the huge growth, I mean, in fact, PlayStack, some of this tech they've got about finding new games, early successful games, they've got the software that identifies what makes players tick. And it's very clever, so they can identify the high probability, of games being successful. But to me, for growth and lower risk, Satago is amazing software. And I've just got the sort of presentation deck through, and I just looked at it again. I think, oh, this could be massive. It really could. I mean, they've got Lloyds and Sage, of course. They're now in talks with banks in the Middle East and Europe. So it's really exciting, actually, Satago. And the work that's gone into it is phenomenal. But it's one of those best-in-class softwares that, I said it's going to get bigger and bigger. It's very exciting.
Yeah, I mean, when you look at your sort of portfolio and stuff like that, then because it's micro cap, you're going to have to accept volatility, which is what you do, and that's your game and stuff like that.
Oh, it's been hard though. I didn't.
But when you look through the lens and say, well, okay, if you have a portfolio of sort of 8 or 10 really micro, caps, which you have, okay, and this is how I would view it, would be such that 2 or 3 of them will absolutely fly in 3 or 4 years, whichever that is, Satago, XBF, or whether it's any other one, eEnergy, or whatever it is, like those will absolutely just knock your ball out of your park. And just in those 2 or 3 will more than double your portfolio's value on their own. So even if you get a couple of duds, and I get a couple of duds in mine, and I've got a bigger cap portfolio, even if you get a couple of duds, yes, it's painful and they're wrong, but you basically you've got the heavy lifting already done. And that's the way to look at it, is that you just got to accept that some of the small cap companies are going to not work and may even go to zero, which is what occasionally happens. But the 2 or 3 winners that you have will absolutely produce monster returns, and it's having the guts to stick through the volatility to see those days through.
Yeah. And do you know what? There's also a way, like I said, I've got a sort of 9-point thing that I've evolved all the time. When I have a failure or it doesn't do very well, I look back at it and think, why didn't that do well? And essentially, it's quite obvious sometimes. It's already, I bought it. It didn't really tick the boxes I had in place anyway. And sometimes that your heart goes into something and it doesn't pay off. But with a lot of these, you can say, does it, what's the end market? Is the revenue growth ticking up? Is it close to sort of profitability, or they burning cash? Those kind of things you can narrow your chances down and increase the probability of success. But sometimes it's just the emotions, you get carried away with the company. And of course, it's all your weightings. The longer you hold a company, the more likely you are to see whether it's going to be a success or not. And so you can just ease up on the weighting, or actually put more in, so on downturns. And
the other thing I think you've added really well, 2 things you've added really well over the last 2 or 3 years is, one, that valuation layer. You've started looking at what you think it's worth compared to what the price is and what the upside is. And equally, I remember when we first chatted, you said to me, I just ignore all the macro. It's a load of rubbish. You don't even need to look at it. And now you're really into dovetailing the detailed micro research that you do in terms of those companies and markets, with the overlay of actually the bigger picture movements in terms of monetary policy, fiscal policy, inflation. And that's really, it's perfect combination. That is the way to do it. Top down, bottom up being the most important for micro cap, plus having that valuation layer and the vision to be able to, and the stomach to be able to stick with it.
Yeah. But the thing is, and also, I've said, I've learned a lot of it. In fact, bonds have come to the fore like no other thing. I remember.
Yeah, well, there you go.
Absolutely. I remember a year back saying, I don't care about bonds too much, but 6 months back.
And you say about macro as well.
Now everyone's talking about bonds. It's like, do you know, the funny thing is, in a bull market, I said this before, in a bull market, you can afford to make mistakes, and you won't get punished. In a bear market, you won't. You'll get whipped and knocked down hard. I mean, I've seen companies, meet expectations go down. I've seen companies below expectations take 60-70% off. I've seen some of the companies really get knocked, and you think, wow, So in a bear market, I suppose you've got to pay attention to more detail, and you learn more in a bear market always. And it won't happen again in a couple of years' time. We'll have a bull market, and we'll get sort of we'll get a bit sort of lax on the old macro and all that stuff again. And you realise you have a sell off. You start learning more. But bear markets are amazing times to learn about things. How are things ticking? What's working here? I don't understand, because and you realise most of the stuff at the moment isn't working anyway. But you still got, that's how you learn, But yeah, it's an amazing time for that. But
yeah, another one where you talked about you sort of introed eEnergy with the sort of visibility of the order book. Well, another one with really good visibility is Avingtrans, which is a sort of specialist in East engineering. We've talked about it, of mission critical parts and services to the nuclear industry, defence, industrials, and a bit of oil and gas as well. But nearly 70% of that business is defence and, in the nuclear and the industrials. And these, just to remind investors, they have long-term contracts with things like Sellafield to do their nuclear low-level nuclear waste storage boxes, and they're the sole supplier into Sellafield on that one. They do the blast-proof doors for the HS2 for the tunnelling. They do critical pumps into sort of like the life extension into the nuclear facilities. So they've got these really long-term contracts with great visibility, and 90% of their turnover is just entering this new financial year is already in the bag for this. And they can see, I think it's 45% for the year afterwards. So they've got really, really good visibility. And they're increasing their mix in terms of the OEM in terms of parts versus aftermarket. So they're selling more. They're selling more aftermarket. Plus, they've got the upside on that on their Magnetica healthcare business, their small form MRI scanner, and they've still got, we're really cashed up. They've got plenty of sort of like net fund. They've got 17 million of net cash on the balance sheet, looking for acquisitions, and the track record of Steve McQuillan and Stephen King is fabulous on the M&A side. So I wouldn't put it past them to use that to good measure. And the shares have ticked down probably because this is also what's been quite interesting in the background. We've had you've probably heard about it, all this gilt blow up from the government's unfunded, and we've had LDIs, but the LDI pension schemes have not only been selling gilts, they've been selling everything else they can get their hands on. So CLOs. They've got obviously other corporate debt, but also their stakes in funds, and that's caused fund redemptions. And so if you're a fund manager and you've had one of these LDI pension schemes taking money out, you've had to sell some underlying stock. And what we've seen is some good performing, high liquid small caps being hit out. And I've had EQLS and Crestchick and or even Argentex and Avingtrans, which have all done well, have actually been used as a source of funds because fund managers can take it out, and those create buying opportunities. But I would say this is another best-in-class specialist engineering company making mission-critical parts and systems for long-cycle industries where essentially their products and services are best in class, and they may only be the only source in there. And let's be clear about it, energy transition ain't going away anytime soon. And on the nuclear, we've got the decommissioning side in terms of the storage boxes. We've got the life extension side. We've got Japan, the UK, Germany, continuing with their nuclear, and we've got new nuclear as well with the small form stuff that things like Rolls-Royce is doing, but also Bill Gates is doing with TerraPower out in the States, etc. And these guys service all of them. So that whole sector is really, really flying. And if you want something that is tried and tested, has been delivering 20% returns over the last decade, then you can don't look too far away from Avingtrans because when you've got such a rock solid sort of like fortress balance sheet, same as Argentex, same as EQLS, and your business is growing, and you've got really good strong secular tailwinds between the verticals that you're servicing, hey, you're not in a bad place. So
Yeah, absolutely. Yeah, do you know what? It's been mad, isn't it, the last few weeks about the bonds? Everyone thought pensions and bonds were very sensible, little industry that's ticked along. Then all of a sudden you realize these pension funds got leverage up to their eyeballs on certain. What's going on? So I think people have learned a lot this week about bonds. It's phenomenal. But
I did sense a sort of like a tinge of irony and sarcasm there, Justin. But I'm with you. I mean, you think they're boring, but frankly, they've been gearing themselves up to the gills in these, weapons of mass destruction, the derivatives, haven't they? I mean, it's just frightening.
I was talking to Russ Mould last week, and he said, I've been in the industry for 30 years. I did not know pension funds were leveraged on these kind of products. He said, and so it's a very niche area, but they realize the fallout it can have, and it's very scary to think that this is underlying. There's so many layers in the financial system that we don't really know about. And but I mean, what's good is today, last time I looked, the market's up a little bit, and this is the day that Bailey said that's it, no more. I don't know whether he's going to do any more bailouts, but hopefully that's going to pass now, and we'll smooth the market. Well, apart from politically, even the market's even rallying on the fact that Kwarteng and Trust may be out. So I can't see them lasting till Christmas. And to be honest, that's quite good for the economy.
Yeah, I actually think what will happen is that as soon as the LDI pension schemes have rebalanced or reduced their exposure, it isn't just in gilt, but as I say, they'll be selling lots of other stuff as well. But once that's worked its way through, which hopefully will be, if it's not today, will be in the near to future, I think you'll see a rally on the stock market in the UK.
Do you know what? I literally tweeted out a chart, which is funny, but day before yesterday, I think it was, saying, right, we're so oversold now on the indices, the NASDAQ, everything. I think we'll see a rally. I don't know if we'll retest this later on, but 3 or 4 months on the line, but I think we'll see a rally. But then CPI came out, and I think it went down. I thought that's a bad prediction, but it went down and bounced back up. So I think we may see a Santa rally with the government policy in the UK doing a bit of a U-turn, and just things being so oversold. And I don't know if inflation is sticky; it hangs around for a while, so we may see a retest. But I think we're nearing, and we've said this before, but I think just the capitulation that's happened, the speed of sell that's happened recently. I'm looking back at metrics, and never been this oversold on MACD levels for a while in the indices. So I think we could see a good rally, just technically, for over the next few months.
And you're going to
have a Santa rally.
And are you going to do anything on your portfolio in the next couple of weeks? Are you sort of been buying, selling at all, or anything like that?
Not really. I've been sitting there. I mean, because I don't want this is the way investors are, a bit risk averse, and I sort of am at the moment. Being so hit over the heads for so long, so often. It's like I'm going to sit and wait until there's a sort of bottom in there's a general trend going upwards, and I'm happy to be late and correct rather than early and wrong, which has happened a lot. So I'm just to sit and wait, but I'm quietly sort of happy with it. I'm sort of glad the sell-off happened yesterday and it bounced back up. To me, the bad news came out, it tested a low, bounced back up. That's quite bullish in my mind. I'm thinking, so okay, people are knowing now the Fed's going to sort of do what they're going to do, but it's sort of priced in a little bit, isn't it? If you bounce
all I would say is that don't kid yourself if you think you're going to be late and correct, okay? Because how do you know?
Incorrect.
No. How do you know whether if it's a bear market rally or basically a proper full-blown bull market? You frankly don't. It's just like it's a crapshoot, because as we saw yesterday, the markets move in mysterious ways in all types of different things. The key for me, and the number one principle I would say to investors take away is think long term. Don't get too annoyed when your portfolio takes a dive in the short term, even if it's a year or 18 months. If you look for 3 to 5 years, then your portfolio should, in theory, be a lot higher, and that's the gold at the end of the sort of rainbow.
Oh yeah, well, I've held my stocks now for 3 to 5 years now. So it's and the thing is, I just genuinely try and look through it, and on a daily basis, you think, and it is all about the market, is what is priced in, that because we have come down a lot. I mean, AIM this week at a new low, 42% pretty much. It's now over 400 days since the high. That's now within the average. So S&P is not quite, and Nasdaq's not quite there. I mean, January would be sort of 12 months for them, but so 12 to 16 months or 12 to 18 months, it's bad. The best case scenario is January is the bottom rally in the S&P, but of course inflation is going to feed through for a while, and it's going to hit earnings. But how much of that is priced in already, we don't know yet. And how bad some of these companies drop out of bed, we don't know. So it'll be a bumpy ride, But well, the thing is, will the news stop getting worse? And that's what we've got.
Or will the news stop? Won't get less. We'll get less bad. That's the key.
Yeah,
will the news get less bad? And if that's the case, then the delta is going to help it.
Yeah, exactly. Marvelous.
Great, sage words there, Justin.
Yeah,
I'm with you.
By the way, a little tip there. I don't know if you saw this. Have you watched on Netflix the GameStop saga about the short covering?
No.
It's worth watching that. Honestly, It's phenomenal. It's about the funds against the retail investors and how literally there's a couple of retail guys who are very sharp. And they said, this guy looked into GameStop. He said, there's 112% short coverage on this. He said, I don't understand how that could happen. And then now that people are actually scanning for these kind of companies, the way there's have a lot of shorts on them, and yet it literally went crazy, didn't it? GameStop. This one guy I think made a retail investor. He made sort of over 3 million off just a low base there. But yeah,
he'll blow it. Don't worry.
Yeah, he probably will, but it's very interesting. But it got me thinking about Boohoo as well, but the short covering on Boohoo. Now, and it's not anywhere near, it's about 10%. But I think that could, if they come up with some figures that are not as bad as people expect, and the shorts cover a little bit, you could see a technical bounce there. But I think above 40 pence on that may see a trend upwards a little bit. But I mean, it'd be interesting to see if some of the shorts start covering, and keep an eye on the volume in Boohoo, because I just think, with their automation and they're aiming for higher margins and all that stuff, it may improve very quickly if they have some kind of positive update.
All I would say is that if you're going to fixate on short-term fast bucks, it's going to undermine.
No, I'm not.
No, I know. I'm not saying you are, but I'm just saying.
No, that's a gamble. I know, but Boohoo as a business was very, very good as a darlings of thing, and they've taken a massive hit, of course. And I think that the question is, will they get back to that former glory? Now they're working hard to try and do it. Can they do that? So I'm just watching and reading updates. I was reading the results last night, and but that's the thing I'm doing. I mean, you must think that, actually. You got in there. You must think they're capable of getting towards it.
I was talking more about the broad principle. Yeah. Don't go for fast bucks. Go for long-term returns. If you try and time stuff in the days or quarters or weeks and stuff, you will undermine your long-term returns.
Listen, I'm not investing, but I'm watching financial updates from them. So
but that's separate to Boohoo. If you spend your life surveying the market for short stocks which have been shorted, you're asking for a kick in, mate. I'll tell you.
I'm not doing that. I mean,
I know, but I mean, that's what with the intro with GameStop. That's what I'm saying.
No. Just very. I always love documentaries on investing, trading, anyway. But that's very well done, and it's like an anomaly that happens every now and again. That's the trouble. People hang on to that and think, oh, there's more of those out there. No, most of the people lost a lot of money there, including funds and stuff, and it wasn't a good business anyway. So first and foremost, focus on a good business. That's where you need to go. But Boohoo was a cracking business, and it's been hit by costs and stuff. And so I'm thinking, now can it get back to being a very good business? And they are working hard to do that. So it's worth looking at when you consider it's being down 90%. You think, wow, that is nuts. So it's a company or a business worth monitoring, because they are trying to improve. But you must think that, so you hold the company,
Yeah. No, I do. I'm with you, Justin. Anyway, well, let's park it. Let's park it for now.
Let's park it for now,
and we'll speak in 2 weeks.